Dear students, today's session is very important, so don't miss a single second of it, as I will go over the most important aspects of departmental accounts in great detail, including interdepartmental transfers, when unrealized profit occurs, and how to eliminate it when a profit margin is not provided, as well as an examiner favorite concept. What exactly do you mean interdepartmental transfer? One department is transferring goods or services to other departments within the entity is known as interdepartment transfer. IDT transfer can be at cost price or normal selling price. Interdepartment transfer from D1 to D2. D1 is sending the goods and D2 receiving the goods. D1 records as sales and D2 records as a purchase. Dear student, interdepartment transfer, purchase and sales are shown separately because the entity can easily differentiate inter and intra sales and purchases and evaluate the performance of each department individually. By IDT, D1 credit IDT as a revenue and D2 debit IDT as an expense. Let's take an example. Department A purchased raw material, incurred wages and factory overheads and processed goods by incurring 1 lakh cost price and transferred to Department B at cost price of rupees 1 lakh. Department B sold all goods at 1,50,000. Now we will prepare trading account for both departments. Department A debit with cost of 1 lakh by IDT at cost 1 lakh. What is the Department A gross profit, Nana? Debit 1 lakh, credit 1 lakh. So 0. Department B purchases 1 lakh, sold goods for 1,50,000. So what is the gross profit? 50,000. Dear students, what are your comments? If you work with Department A, will you support the company's decision to send goods at cost price? We will not support, sir, because promotions and other employee rewards or benefits are based on performance. Department-wise accounts are prepared to know the performance of each department individually. Interdepartmental transfers at cost price are not preferred because we are unable to assess the efficiency of managers and employees. As a result, they will get demotivated as their efforts go unnoticed and employees' benefits will be lost. Department B employees are always receiving benefits and they may believe that if he sees working properly, production will suffer. As a result, interdepartmental transfers are preferred at selling price. Before we move on, if you enjoyed this video so far, please hit the like button and remember to subscribe to our channel for more great content, as well as share it with others who need it. Concept of unrealized profit or provision for stock reserve is very important. First question arises, sir, when unrealized profit arises? Unrealized profit arises if the following 3 conditions are satisfied. Condition number 1, there should be interdepartment transfer. Condition number 2, interdepartment transfer should be at selling price. Condition number 3, there should be some clothing stock with the receiving department out of interdepartment transfer. Dear students, we will understand the concept with the help of an example. D1 transferred goods to D2 at selling price 50,000. Profit ratio 10% on sales. Unsold stock left with D2 is 20%. Dear students, first check whether 3 conditions are satisfied or not. Is it interdepartment transfer? Yes. IDT is at selling price? Yes. And some of those goods are still unsold out of IDT? Yes. All 3 conditions cumulatively must satisfy. Now, the question arises, sir, how to compute stock reserve? It is very simple, ma. Unrealized profit or stock reserve equal to receiving department clothing stock of IDT into profit ratio of sending department. In our example, out of 50,000 IDT, 20% was unsold. So 50,000 into 20%. How much? 10,000. Stock left with receiving department is 10,000. Receiving department clothing stock of IDT 10,000 into profit ratio of sending department 10%. 10,000 into 10%. How much? 1,000 is the stock reserve or unrealized profit. Dear students, mark my words, unrealized profit will not be eliminated from any department. It will be eliminated from general P&L or combined P&L or consolidated P&L. I hope you enjoyed the concept. Let's pick an examiner favorite question. Now the students want to know if it's important for CA or CMA. It's important for both. And one of the most common examiner questions in departmental accounts, one is elimination of unrealized profit and other one is computation of manager's commission, which we will cover in the next session. KGF Limited has two departments, A and B. From the following particulars, prepare departmental trading account and consolidated trading account for the year ended 31st March 2022. Opening stock, purchases, carriage inwards, wages, sales, purchase goods transferred, finished goods transferred, return of finished goods. There are two departments, Department A and Department B. There are lot of mutual transfers in these departments. They deal with two different types of goods. One is finished goods and the other is purchased goods. It is actually raw material and finished goods. Purchased goods indicate that they will purchase raw materials and convert them into finished goods. Each department is dealing with purchased goods and finished goods. They are not only transferring finished goods but also transferring purchased goods. Purchased goods, when they are transferring between departments, it was transferred only at cost price. We buy for 100 and we transfer at 100. But when the finished goods are transferred, it is transferred at market price. Pay attention, my dear students. Beginner mistakes possible area. Market price is not 20%. 20% is not margin. Read the question. 20% of finished stock bracket closing at each department represented finished goods received from the other department. 20% represents finished goods stock in each department out of InterDepartmental Transfer. For finding unrealized profit or stock reserve, we need receiving department closing stock of IDT and profit ratio of sending department. The issue is that profit margin is not given. So, we must learn how to deal with this type of situation. They are asking us to prepare two things, departmental trading and consolidated trading account. Consolidated trading means for the business as a whole without separate column for departments. Transfers between departments should never be considered incomes or expense for the business organization as a whole. Only for the departmental accounts viewpoint, we book it as a revenue and expenses. First, we'll prepare departmental trading account. Expenses directly attributable to a particular department are debited to the respective department account. To opening stock, Department A 20,000, Department B 12,000. To purchases 92,000, 68,000. To carriage inwards 2,000, 2,000. To wages 12,000, 8,000. Sales credited to departmental trading account 1,40,000, 1,12,000. By transfer out purchased goods as well as finished goods. To transfer in purchased goods as well as finished goods. Now, whatever finished goods we transferred are returned also. So, by returns, which goods? Finished goods. To returns in finished goods. First, purchased goods. B to A means sending department should be credited and receiving department should be debited. B is sending department and A is the receiving department. B should be credited how much? 10,000 and A should be debited how much? 10,000. So by transfer out purchased goods, B should be credited 10,000 and A should be debited 10,000. Next, A to B. A should be credited 8,000 and B should be debited 8,000. Next, finished goods. A to B. A is the sending department and B is the receiving department. Sending department should be credited and receiving department should be debited. So A should be credited with 35,000 and B should be debited with 35,000. B to A. B should be credited 40,000 and A should be debited 40,000. Return of finished goods by A to B means purchase returns. Either we can deduct from purchase or write on credit side. So A should be credited with 10,000 and B should be debited with 10,000. Return of finished goods by B to A. How much? 7,000. 7,000 should be credited in B department and 7,000 should be debited to A department. By closing stock, purchased goods, Department A 4,500, Department B 6,000, finished goods, Department A 24,000, Department B 14,000. Dear students, find out the gross profit. To gross profit, Department A 38,500, Department B 46,000. Dear students, unrealized profit will not be eliminated from any department. It will be eliminated from general P&L or consolidated P&L or combined P&L. Now we are going to prepare consolidated trading account. In the consolidated trading account, we will have two opening stock total, Department A plus Department B, 32,000. Two purchases, 1,60,000. Buy sales, 2,52,000. Two wages, 20,000. Two carriage, 4,000. Buy closing stock, purchased goods 10,500. Finished goods we are yet to find out. We will not have any other transaction, interdepartment transfer, purchases, sales, returns, all things won't come in consolidated trading account. Now, one thing what we required is finished goods. Finished goods stock out of IDT in each department is given, but profit margin is not given. Can you find out the gross profit ratio? What's the gross profit? Department A 38,500. What is the sales? 1,40,000. No. This profit means 38,500 is not contributed only by external sales. This profit is contributed external sales as well as transfer of goods. During the year, there have been interdepartment transfer of purchased goods and finished goods. It is given that purchased goods are transferred at cost. No unrealized profit exists in the closing stock of purchased goods. Unrealized profit is included in the closing stock of finished goods as the interdepartmental transfer have been made in regular market price. Listen now, working notes. Closing stock out of IDT is given but profit ratio is not given. If profit ratio is missing but it is mentioned that IDT has been made at normal selling price, then the following steps are applied. Step 1. Calculation of gross profit ratio for sending department. Particulars, Department A, Department B. Sales. Under sales, write down external sales. Department A 1,40,000. Department B 1,12,000. Add internal sales. Department A 35,000. Department B 40,000. My dear students, we find gross profit ratio on gross sales or net sales, only on net sales. Let's written in Department A 7,000, Department B 10,000. What's the net sales, Nana? Department A 1,68,000, Department B 1,42,000. Find out the gross profit ratio. Gross profit ratio equal to gross profit divided by net sales into 100. Gross profit, Department A 38,500, Department B 46,000. So what is the ratio, Nana? Department A 22.925% and Department B 32.39%. Now let us compute stock reserve and cost of finished goods. Cost of finished goods, Department A, Department B. What is the closing stock given? Department A 24,000, Department B 14,000. Now how to compute stock reserve? It is receiving department closing stock of IDT into profit ratio of sending department. 24,000 into 20%. You should apply the margin of B. 32.39%. 24,000 is the stock of A, includes 20% stock of B. In that case, I should apply the margin of B. How much, Nana? 24,000 into 20% into 32.39%. How much? Equal to 1,555. Similarly, 14,000 into 20% into 22.92% equal to 642. In that case, cost of finished goods, Department A 22,445, Department B 13,358. Total cost of finished goods 22,445 plus 13,358 equal to 35,803. Total cost of finished goods 22,445 plus 13,358 equal to 35,803. To gross profit 82,303. You can cross check Department A gross profit 38,500, Department B gross profit 46,000 minus stock reserve 2,180 equal to 82,303.